Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. It's not uncommon for those who achieve professional success to amass wealth that is greater than they need to live a comfortable life. There are several solutions to this. Perhaps it's early inheritance gifts as per the die with zero approach. Maybe you update your travel budget and it's first class all the way. Or perhaps you choose to support charities of interest. Another approach, however, may be to think about intergenerational wealth. Perhaps building wealth that supports many future generations. We've been having these conversations with a few of our clients recently, so in this week's episode, I wanted to share with you some of the ideas and implications of this change of approach, thinking beyond just providing for your life and maybe handing on just to your children. All right, so let's dive into this week's episode, Investing When Your Time Frame is Beyond Your Lifespan. An intergenerational time frame to investment has been seen amongst the aristocracy in Europe for centuries. In Australia, we do see it sometimes, however, most noticeably in farming families where the land is passed on through the generations. The Maya family dynasty is perhaps another significant example. Australia is actually pretty well suited to intergenerational wealth given we have no estate or inheritance taxes. Sure, there's capital gains tax, but that's only triggered when the asset's sold, which provides the potential, where the ownership is structured correctly, for assets to be retained with minimal tax erosion for very long periods of time. Investing with an intergenerational mindset requires a recalibration of the purpose of wealth. It switches from being the fuel that enables your consumption to something that echoes out long after you're gone. With this changed mindset, your investment time frame alters, and that is what then significantly impacts your investment approach. Instead of investing to provide you with a secure retirement for the next 20 or 30 years, now you're thinking about sustaining and growing wealth for perhaps 100 years or more. The primary consequence of this extended time frame is the absolute necessity to protect against inflation. We all know that $100 today won't buy you the same amount of goods and services as it would have done a decade ago. You've probably come across people in your life who bought their first home long ago for $10,000 or $20,000, and today they're sitting on assets with seven-figure valuations. The spending power of each dollar erodes over time. That's what inflation is. For an investor wanting to secure intergenerational wealth or financial security for future generations, the absolute priority must be to ensure that their capital maintains its purchasing power as a minimum. So how do we approach this? Well, clearly what we need is to ensure that wealth is deployed into assets which maintain their value once inflation is accounted for. Property and shares are the clear first line options. What you need to avoid is fixed interest types investments, particularly where the interest payments are distributed out and utilised. Having a long time frame significantly alters what it means to manage risk. As mentioned, the biggest risk becomes not keeping pace with inflation. Risks that we would normally worry about, such as volatility and liquidity, become far less relevant. If you're investing with a 100-year time frame, your wealth is going to experience many ups and downs. Since you're a long-term holder with no plans or needs to sell, these waves are of no great consequence other than potentially providing you with the opportunity to put any surplus cash that's accumulated into the market to buy while prices are down. Share portfolios work really well for this use case, though they do require some monitoring. Companies merge or get taken over, and of course new businesses rise up, often associated with technological change. A simple buy and hold portfolio of direct shares over a 50 or 100-year time frame even probably won't work out. I mean, as an example, you're not going to hold your Microsofts and Googles of the world if you set up your share portfolio 50 years ago. You'd end up sitting on a whole bunch of yesterday's heroes and have no exposure to up-and-coming enterprises. So active management could be one solution for this, but another would be to simply replicate market indexes. Now, these, of course, they've only been part of the mainstream consciousness for the last 10 or 20 years, so who's to say what the state will be 20 years from now? But certainly an index approach to investing, and as regular listeners will know, that's consistent with our investment philosophy here at Guidance, but an index approach would ensure that your portfolio adjusted over time, gaining exposure to emerging opportunities whilst reducing allocations to businesses that have failed to keep up. Someone investing for intergenerational wealth will have their immediate needs covered. I mean, you wouldn't be contemplating an intergenerational strategy if you didn't have your own needs covered in the first place. This means they can afford to lean into assets with long-term growth prospects, potentially using debt as a way to magnify your progress. A classic example would be investments in commercial property. Owners of commercial property enjoy the benefits of having almost no outgoings. The tenant's responsible for all the normal running costs, things like insurance, council rates, that sort of stuff. Now, at some point, the building might need a new roof or just generally wear out, and that is a problem to be solved by the property owner. But for the most part, commercial buildings are relatively easy to manage with regards to cash outflows. This means there is the potential to borrow and use the rental income to clear the debt. Note that it is important to be diversified if you undertake this approach, because the one drawback with commercial property is that if a tenant leaves, the property can be vacant for long periods of time, sometimes even multiple years. And then even if you get a tenant, often it might be the first 3 months or 6 months is rent-free while they fit the place out. An owner who has debt linked to the property needs to have other income sources to keep the bank at bay during this period. In researching this topic, one observation that I came across, which I thought was worth sharing, was that money rarely survives across 3 generations without the following ingredients: financial literacy, shared context, and open conversations. Now, financial literacy is pretty easy to grasp, the concept that is, anyhow. Shared context is an interesting one, though. This is about having some degree of everyone rowing in the same direction. The further you go down the generations, the more difficult that's going to be, as you've got more and more people involved and you've got spouses and other complications. So to address this, successful families often have significant philanthropy projects that pull family members together and provide meaning. Open conversation is the third ingredient here, and once again, I found that to be quite interesting, because for most of us, the normal impulse is to keep financial matters private. Success in managing intergenerational wealth, however, requires that everyone involved has a clear picture of the overall wealth position and the objectives it's looking to solve. As the person who's setting the strategy on its way, it's important that you lead the charge in this regard. Investing with an intergenerational mindset implies that all of your wealth upon your death will not simply be passed on to the next generation as inheritances. Without open conversations, this could come as a shock to your children and potentially create conflict. This perhaps leads to a final observation worth making in this episode. Be sure to reflect on why you're going down this path. So, a good reason would be that the level of wealth that you've amassed is so significant that passing it on to the next generation is more likely to have a negative impact on their life than a positive one. But a poor reason would be a lack of trust in the future generations of your family, a feeling that you want to control things beyond the grave. If that's the motivation, just stop and question, because maybe that's not being fair to your children and perhaps their children as well. All right, well, look, that's it from me for this week. Something a little bit different, but hopefully one that you found interesting. And who knows, if it's of direct relevance for you, then congratulations on building what you have. And hopefully this offers some useful thoughts. I'll be back in a fortnight's time, but of course Nick will be on with another Wealth Builder podcast next Wednesday. So until then, bye for now.